Hey CPA candidates, this is Matt from Universal CPA Review. Thanks for checking out this video on adjusting journal entries. I'm sure you're aware how important this topic is for the FAR section of the CPA exam, and you're going to see it again in audit. Now, in this video, we're actually going to simulate a company's process. We're going to learn how they take the unadjusted trial balance, go ahead and identify adjusting journal entries, record those adjusting journal entries, and what the ultimate impact is on the adjusted trial balance. Before we dive into the video, just a few things I want to touch on. In the bottom right, please subscribe to our YouTube channel. We pump out a few new videos every week. It'll give you a good balance of what we're all about. If you're studying for the exam and you need some support, join our Facebook study groups. The links are in the description. If you haven't yet tried the Universal platform, please go try the free trial. Just go to our homepage at the top, start that free trial, no credit card required. And then lastly, please reach out to us about any discounts or promotions. And if you've already purchased a review course, and guess what? It's not getting the job done, and I'm not surprised. Well, we have a special program in place for you, and that's called the Spilt Milk Program. Not only will you receive a discount, but there's other things that we're going to help you do to get back on track. So, are we ready? Let's dive into the video. Team, I want you to take a deep breath because today is an extremely important topic. So fire yourself up. We're focused on adjusting journal entries. And adjusting journal entries is one of the more difficult concepts to understand in FAR. And one thing I want you to do is don't memorize journal entries. Journal entries cannot be memorized. We need to understand the intuition behind an entry and why we would debit this account versus credit that account. Because I can promise you, you're not going to be able to memorize all of the entries you're going to need to know for the exam. You're just going to have to understand them so that when you are presented with a situation, you know exactly how to process the idea of coming up with what the journal entry would be. So in this module, we're going to talk about the purpose of adjusting journal entries. We're going to talk about preparing an adjusted trial balance. We're going to go through some examples of adjusting entries. And then ultimately, we're going to see how that impacts the ending adjusted trial balance, which is used to prepare financial statements, right? So very important day to day. So focus in. So at the end of the period, right, we'll have our trial balance. And that may or may not be what the ultimate final trial balance is that feeds into creation of the financial statements. So what we need to do is go through and assess, okay, what business events are present for this company? Do we need to make any adjusting entries for those events, right? That will allow us to either include, exclude certain revenues and expenses, and that will impact the balance sheet as well, right? So as a company goes through their financial close process, they'll go through all of the trial balance accounts and assess, okay, do we need to make any adjustments here? So looking at our mental map, this is how we're going to think about adjusting journal entries. So as I mentioned, the first thing we need to do is identify potential events that result in adjusting entries. So for multiple choice questions or simulations, what they'll give you is certain scenarios or events, and you'll have to determine, okay, do we need an adjusting entry? And if we do, well, let's move to step 2, right? That's where we would need to determine the required adjustment. Now, this may be adjusting a balance sheet account. It may be including or excluding certain revenue or expenses, but ultimately, we're going to figure out what the required adjustment is. So once we know the required adjustment, we would then move to step 3, which is where we need to figure out, okay, what are the debits and credits for this adjusting journal entry? Now that is easier said than done, right? It's hard to know what the debits and credits are, but trust me, through practice and fully understanding how certain entries impact the financial statements, you're going to become an expert on journal entries. So once we know what our adjusting journal entries are, we need to record those into the trial balance so that we get from our unadjusted trial balance to our adjusted or adjusting trial balance, right? That would be the final set of accounts that is then used to prepare the financial statements. And at that point, we're fairly confident that we've factored in all of the different events at the end of this period so that our financial statements are correct and accurate. So for the rest of this module, we're going to simulate what a company would do at period end, right? So it's either the month end, the quarterly end, or the year end, and they're going through, and what their first step would be is to export the trial balances, right? And nobody really knows, are those accurate? Are they inaccurate? So what we need to do is go through line by line or account by account and determine, do adjustments need to be made? Let me make an analogy for you. Let's say that you are going on a long trip, right? It's a 15-hour drive. And you have your car that you've been driving around town, but when it comes to taking it on that long drive, you know there's changes or adjustments that need to be made, like changing the tires, the brakes, changing the oil, right? To get it ready to take on that long drive. Well, the same is true for a company's trial balances. They need to take those unadjusted trial balances, really dig in and make sure that everything is properly stated and that all the different business events have been factored in, right? So they would prepare those adjusting entries, and once all of those adjusting entries have been booked, you now have a final set of trial balances that you're confident in, and those can be used to create the financial statements. The same is true for your car, right? Once you've made all those adjustments, you're like, I feel super comfortable that my car can make the drive. And so then you go on that drive, right? So that is kind of the analogy of why we need to make adjusting journal entries to our unadjusted trial balance to get to an adjusted trial balance that can be used again to prepare the financial statements. So the fictitious company that we're going to walk through this for is Mighty Dragon, right? The fiery Mighty Dragon. And as you can see, this is a template for their adjusted trial balance. In the first two columns, we have the debits and credits for the unadjusted trial balance, and we have all of the different trial balance accounts. So as you know, a debit balance is positive and a credit balance is negative. And as you can see at the bottom, well, the debits sum to $82,000 and the credits sum to $82,000. And you'll also notice that it includes balance sheet accounts, it includes sales, and then it includes all the different expense accounts. So then in the middle column, this is where we would record our adjusting journal entries. So we'll go through and I'll show you the examples, but ultimately we're going to have some more debits and credits there. And then we'll sum all that together, and that gives us our adjusting trial balance. And that is the final set of accounts that would be used to create the financial statements for Mighty Dragon. So the first account that we're going to focus on is accounts receivable, and this is gross accounts receivable. Now there are tons of different types of adjusting journal entries. We can't go through them all. So throughout the rest of this module, I've picked examples that you're most likely to see on the exam. So in this one, it says that Mighty Dragon shipped goods to a customer on December 31st, year one, right? So on the last day of the year, they shipped out the goods. They want to recognize that revenue. Now, obviously, the customer, they did not pay till year two. And the sale was for $500, and it says it was not included in the company's financial statements. So what adjusting journal entry should they record? Well, guess what? We're going to have to record both the receivable and the revenue. So that's just going to be a debit to accounts receivable for $500, and then we would credit net revenue for $500, right? In both cases, the debit increases accounts receivable and the credit increases revenue, right? So that adjusting journal entry would properly include this sale to be in the company's adjusted trial balance so that when they create the financial statements, they have this revenue and receivable recorded. So how would we record this adjusting journal entry into our adjusted trial balance? Well, the debit to accounts receivable, that $500, that goes in the debit column. That's always going to be a positive number. And then for revenue, it's going to be a credit. And since it's a credit, it's a negative $500. So that is how we would record it into our adjusting journal entry in our trial balance. The next account we're going to focus on is the allowance for bad debt. Now, you'll learn the different methodologies for recording the allowance for bad debt in later modules, but for now, All this says is that basically Mighty Dragon determined that the year-end balance should be $750. But when we look at our unadjusted trial balance, the balance is $500, right? So what is the adjustment needed? Well, we would take that required balance of $750, subtract the current balance of $500, and that means the adjustment we need to record is $250. So when it comes to the debits and credits, well, we're going to have to increase the reserve. And since the allowance for bad debt account is a contra asset, a credit of $250 will increase that allowance account up to $750. The offset is to record additional bad debt expense, and that's a debit for $250. So now we can plug this into our adjusting journal entries columns. The bad debt expense debit for $250, well, that goes in the debit column. It's a positive $250. And then for the credit to allowance for bad debt, that negative $250 is going in the credit column. So that is a very common adjusting entry for bad debt. And like I mentioned, there are several different ways under US GAAP that we can come up with what the ending required bad debt allowance should be, but we'll focus on that in later modules. For now, all you need to understand is how to calculate the adjustment and what the adjusting journal entry would be. The next account is inventory, and there could be a number of reasons for why a company needs to record an adjusting journal entry to inventory at the end of the year. This could be due to a physical inventory account, in-transit inventory, inventory reserves, right? Again, we're going to learn more about inventory in later modules. So let's focus on this example. It says that Mighty Dragon performed an inventory count on December 31st, year one. So what this means is that Mighty Dragon has a warehouse, and all of the employees in the warehouse, they literally went and counted all of the inventory. They said, oh, we've got 500 of this and 500 of that. And they added up all of those items, assigned values, and said, okay, according to our physical inventory account, the company has inventory of 10,500 in the warehouse. So that is their actual inventory that should be on the balance sheet as well. But when we look at the trial balance, it says that the current balance is 10,000. So it's just a little bit short of that required balance that we just counted of 10,500. So guess what? We need to make an adjustment of $500. Now the debit is certainly going to be to inventory, right? We need to increase that inventory balance. Typically, the offset here is going to be a credit to cost of goods sold. Basically means that we over-expensed or over-recorded cost of goods sold. So in this case, we're removing some cost of goods sold. But the important thing to understand is that the debit is to inventory when inventory is actually higher than what's on the company's financial record. So now that we have the entry, how does that fit into our adjusting journal entries columns? Well, the debit for 500 to inventory, that's a positive 500 debit. And then the other piece, the cost of goods sold, that is the negative 500 that is in the credit column, right? So that is a great example of an adjusting journal entry for inventory. The next account is prepaid expenses. And we'll get to prepaid expenses more in later modules, but this occurs when a company prepays the cash for a benefit they're going to receive over a long period of time, right? So a great example is if you have a car, you've probably paid car insurance, and you'll notice they always require you to pay for the next 6 months, right? So you prepaid the next 6 months, but you're not recognizing that benefit until that month comes, right? So that's a prepayment. So in this case, Mighty Dragon expensed $1,200 for their annual insurance on July 1st, year one, right? So that is for the next 12 months, but we're focused on only the 6 months from July 1st to December 31st. And so that means that $600 or half of that amount actually relates to year two. So we need to remove that expense from our financial records, and we can do that by going ahead and debiting prepaid expense for $600, right? Because we prepaid that amount, and at the end of the year, we're going to have that on our balance sheet. And the credit is going to be to G&A expense for $600, right? That's where insurance expense is typically recorded. And basically, when we credit an expense account, we're pulling out expense. Now that we have the debits and credits, how does that fit into our adjusting entries columns? Well, for prepaid expense, we'll put the positive 600 into the debit column. And then for the G&A expense, because remember, we're reducing the expense, that's actually going to be a credit to general and administrative expense for a negative $600. So this is very, very common of an adjusting journal entry for prepaids, because basically what the situation here is that it's on a cash basis and we need to go to an accrual basis, meaning only the $600 for the 6 months of year one should have that expense, right? Any expense related to future periods, well, that needs to be recorded in those future periods. So again, that is a great example of a prepaid expense adjusting journal entry. The next account is accounts payable. As we know, accounts payable, this is where we record invoices from suppliers and vendors, and it sits on the balance sheet until we pay our vendors and suppliers in cash. So this is common to have an adjusting journal entry when there's an expense that is related to the current year, but we don't yet have the invoice. And that's exactly what happened to Mighty Dragon. So they have a marketing agency to coordinate their advertising efforts. Well, guess what? That marketing agency, they sent an invoice for $300 on January 5th, year two. So 5 days after our period end date. And those related to year one marketing activities. So even though that invoice was received in year two, it relates to year one, and under the matching principle, that's when the expense should be recorded. Now, currently, there is nothing in our unadjusted trial balance for those marketing expenses from the marketing agency. So what we need to do is record that invoice. Now, since we haven't paid it yet, that's going to accounts payable. So that's why we have a credit to accounts payable. It increases accounts payable. And then we would debit selling expenses because it's a selling expense, and we need to increase selling expenses for that unrecorded invoice. So let's go ahead and plug it into our adjusting entries columns. So that selling expenses, because we're increasing it, it's going to be a positive 300 in the debit column. And then accounts payable, because we're also increasing accounts payable, that's going to be a negative 300 in the credit column. So again, very, very common. Basically, what a company would do is say, okay, what invoices should we have received for vendors' services that were incurred in year one, but we haven't received them yet, right? So that's what I mean. They have to identify those business events and determine, do we need to make an adjusting entry? The next account is accrued payroll. And this is one that almost always needs to be recorded at the balance sheet date, right? Or at the end of a period, because it's almost never going to be the case, it seems like, that employees have fully received the cash for services that they performed during the year, right? Think about how many times, it comes around to the end of the month and your employer says, well, I'm going to pay you next week. Well, that's fine, but they would need to record an adjusting journal entry to accrued payroll to record the services that you gave them, right? So in this case, Mighty Dragon, it pays its office employees bi-weekly. Now, they last paid their employees on December 15th, year one. Payroll expense from the 16th to the 31st is $500. Now, that isn't yet recorded, and guess what? It hasn't yet been paid. So they need to record an adjusting journal entry. And we would credit accrued payroll for that $500 to record that liability. And the offset there is to G&A expense. It's a debit. That $500 debit increases our G&A expense account, right? So this is almost always going to be on a company's balance sheet and trial balance at the end of the year, because there's almost certainly going to be employees that have services rendered but haven't yet fully been paid. So how does this get recorded into our adjusting entries columns? Well, that $500 debit to G&A expense, that's going to be a positive $500 in the debit column. And then for accrued payroll, since we're increasing that liability account, that's going to be a negative 500 in the credit column. The next account is income taxes, right? A company does not know what their full income tax expense or provision is going to be until the end of the year when the CPA firm comes in and takes the final trial balance and says, okay, this is what I think your income tax amount will be for the year, right? So a company throughout the year, they have what they believe to be their best estimate, but until the CPA firm or the tax firm comes in and says, here's what the number should be, well, we're probably going to need to make an adjustment at the end of the year. So in the example, it says that Mighty Dragon hired a CPA firm to prepare its income tax provision for year one. Now, the CPA firm estimated the income tax provision to be $2,000. What adjusting entry should the company record? Right, so we know the estimated income tax provision as of the latest date should be $2,000, but when we look at our trial balance, well, it's only currently at $1,000. So that means we need to make an adjustment of $1,000. And so if we need to increase that amount, well, we would debit income tax expense for $1,000 and credit income tax payable for $1,000, right? So that is a super common adjusting journal entry that we will see for income taxes. So how does this impact our adjusting entries columns? Well, that income tax expense for $1,000, that's going to be a positive number in the debit column. And then we're going to increase the income tax payable by crediting it for a negative $1,000. So that is how it impacts the adjusting journal entries columns. So we went through a handful of examples. You'll notice not every single trial balance account needed an adjustment, and that is certainly going to be the case for most companies. Not every single account needs an adjustment. Now, I can't promise you that you won't see adjusting journal entry questions on accounts that we didn't cover, but I can promise you that if you focus about what types of journal entries you should book and how to book the debits and credits, you'll be ready to go. So after all those examples, we're now at the point where all of those adjusting entries have been booked, and we can see that in the middle column, right? We see some debits that are positive numbers, and we see some credits that are presented as negative numbers. At the very bottom, it should all equal out to be 0 as well, right? All the debits and credits, similar to the unadjusted trial balance, those should equal. And then we have our adjusting trial balance, which sums the unadjusted trial balance and the debits and credits from our adjusting entries. And this is, again, what's going to be used to create the final financial statements. And as you can see, one of the most important things about this adjusting trial balance is that it sums to 0. If it doesn't sum to 0, then it's not a trial balance that balances. Right? So hopefully you understand the big picture of how we take an adjusted trial balance. We go through, evaluate business events, determine if an adjusting journal entry needs to be made, what is it? We go ahead and book those journal entries, and then we end up with our adjusting or adjusted trial balance, which must sum to 0, and then we can create those financial statements. If you're interested in downloading the Excel workbook that has both the unadjusted trial balance and the adjusting journal entries, and then ultimately gets us to our adjusting trial balance, and that way you can play around with formulas and see how this all comes together, then simply go to the link on the screen. You'll find it's an Ask Joey Q&A page, and you'll be able to download the Excel workbook there. So again, extremely important topic. Definitely spend some time on this. The multiple choice questions, those are going to be all different types of scenarios, but also practice the simulation. The simulation is another experience sort of like we walked through in this lecture.